Yeah, hey, thanks to Peter and the CBA for inviting us to this great panel. Fabulous turnout. Really looking forward to it.
Going to be fun. Big fan of Andrew Maher's. Big fan.
Likewise. Feelings are mutual.
There we go. Should be an exciting morning. We're going to talk about positive things today. Going to be positive.
Well, we think Pedro's going to do a great job. We're hoping. I mean, he's got to be nervous, you know. It's kind of like 4th and goal. See if he can punch it in, but I think he's got it. He's a very good public speaker, unlike myself.
Good morning, everybody, and thank you for attending. My name is Peter Evans. I'm the president of CBA for another 46 days. And thank you for coming. Great turnout, in person, sponsored event. I'd like to acknowledge a couple of people before we get started. First of all, our executive director of the CBA, Adrienne Malley, and her staff. Couldn't do this without their assistance. I'd like to thank Martel for hosting us this morning. And some exciting news to announce. The CBA Achievement Awards will be on March 23rd, 23 at the Intercontinental Hotel. And you'll be seeing an announcement in the next, I think it's another week or so, regarding the CBA's Diversity Impact Fund that we awarded to community-based organizations last year and to a few individuals. So keep a lookout for that because that's coming. I want to take a minute to thank our panel. John Boyle, Andrew Maher, Marci, Griffith, and Dave Martel. A really seasoned group of brokers, owners. Everybody on this panel, including myself, has been a broker at one point or another in our lives. We've all seen 2, maybe somebody 3 corrections in the marketplace. And while some figure that's where we're headed, we might have some alternative views on that position today. We are going to talk about the market. We tried to have a prep call for this, and we got through one question in the allotted hour, primarily dominated by John Boyle. But be that as it may, the only one that has a script today is me. The panel doesn't really have any idea what we're going to talk about or what the questions are. So it was very interesting to hear their positions on some of these things. So I'm going to take my seat here, and because I don't want to stand up, and we'll get going. Okay, as we slowly emerge from the challenges related to COVID, this work from home phenomenon, a new mayoral administration in the city of Boston, and a groundbreaking new governor to take office in January, where do you see the landscape heading for the commercial real estate sector in Massachusetts in 2023? Specifically, what product types are going to survive the choppy waters, anticipated choppy waters, and what type will fall victim? I'm going to start with the most positive person on the panel, Dave Martel.
Marty.
All right, Marty. Well, I'll tell you, the last 2.5 to 3 years have been brutal for office leasing. And I always describe it by sitting in the office over the last 2 years, and we've got our life science guys constantly high-fiving after doing 50 to 300,000 square foot leases. Our capital markets guys were really busy. Our industrial guys have been really busy. But office has been a real struggle. It's hard to sell office space when the world is telling you to stay home. I personally believe that we're in the early first inning of a recovery. Most of the meetings that I'm having with tenants anticipate a back to office model, okay, where everybody we're talking to is saying we're coming back, okay, in some way or form. A year ago, I'd say 40% of the tenants were actively considering, a predominantly work from home or significant work from home part of the week. I think that tenants and companies believe that they have to be back in the office. Now, that doesn't mean they're all coming back in the exact same size. I think that's going to be a challenge. So I do believe positively that we're at the beginning of people realizing that, It's been 5,000 years of humanity, of people coming together to create and to innovate and to collaborate to create great cities and great businesses. I don't think that's going to change. I think my belief is that all real estate, for the most part, is going to be okay in the long run. It's going to be tough in the short run, and I think it's going to be a flight to quality. For office space, we've already seen it. New construction, the stuff that Andrew's working at One Post Office Square has really led the way, and I think that's I'd ask him the question if he's happy with the type of demand. But when you look at it relative to what the last 3 to 5 years have been, it's been pretty good for new construction. I think quality Class A that is differentiated is next in line. 53 states of the world at least really well in the last 2.5 years. And then I think Class A and Class B are gonna, commodity space are gonna lease at some point in time. Right now, it's dark. But overall, I can remember in the early 2003 sitting on a 60,000 square foot floor plate, and I think Andrew, you were on this panel. I know Brian Chason was. Someone asked the question, is this space, this was at 1 Federal Street, is this space obsolete? Will it ever lease? And my answer to that was, yeah, it's going to lease. It's a great location, it's a great building. At some point in time, the demand's going to come back. And sure enough, within 2 years, big tech was coming and they wanted big floor plates. And then there was a point in time, in 2012 to 2015 years, where it was really difficult to find great big floor plates. So every dog has its day. Our business is in really tough shape right now, but overall we live in probably one of the greatest cities in the world, and I think the best city in the country. I do believe positively that that we're going to survive this. It's going to be slow. It's going to be tough.
Marci, what do you think?
So I'll touch a little bit on office, but we don't invest a ton in office right now. That's not where we spend time. But my 2 comments on office. Obviously, it's gone through a structural change, and so it's to be determined what happens to a lot of these Class B buildings. I do agree it's a flight to quality. I do think there's nothing like a recession that's going to bring people back to the office, because who's going to get laid off? It's easier to lay off someone that's on Zoom versus someone coming to the office. I was last week at an event, and one of our colleagues said to me, he just told his 2 kids that are in their 20s go back to the office. They go, why? I only have to 2-3 days a week. He goes, get back to the office. So that is going to help, and I do think the ripple effect to these small businesses in Boston and Cambridge and all these submarkets is we're still feeling that impact, and it's the right thing to do for all these small businesses. So I'm a believer in the flight to quality in the Class A. I'm a believer in suburban office, particularly if you're Needham to Burlington along 128. Those parking lots are a heck of a lot fuller than if you go out to 495. So I do think, but we're still have to. The playbook hasn't been written on what's going to happen with office because of the structural change. We spend our time in industrial and life science, both R&D and GMP and flex, and those asset classes have been less impacted, have benefited from COVID, but are like everyone kind of seeing a slowdown as people try to Amazon's laying off people, FedEx blew up a big deal, so no asset class is unimpacted, but so I do think it's a slowdown in those asset classes. It's more of a cyclical slowdown, certainly in the biotech sector. It will come back, and Boston. Some of the other markets, we focus Boston to DC, and we own a lot in Philadelphia, and that never had the crazy growth that we had in Boston. I mean, in the life science sector, we had 4 quarters of unsustainable growth. It couldn't, we loved it as landlords, but these poor tenants, they would tour, and the next day they're like, sign an LOI, and that's just not an unsustainable sort of market. So it's given, and we had at one point, it went from 30 million to 50 million to 70 million square feet of potential new supply. That's craziness. But if you look back 4 years ago and you said we were gonna double our lab supply and still be low single digit vacancy, everyone said you're crazy. But we are. So I'm a believer in the fundamentals, and I am a believer in office, but that playbook is still to be written.
JB?
Well, first of all, I just want to thank you, Peter, for letting us be up here. Great to be with my CBA colleagues. Honored. I think we at Cushman and Wakefield would state that if your question is about 23, which I think it is, I think 23 is going to be a year of recalibration, and recalibration as it relates to not only terms, rents, but everything that also goes into a letter of intent. I think everything is going to be modified. There isn't, it's times like this that people really lean on brokers, and because there isn't necessarily a market. You know, what is the market TI? What is the market rent? So as it relates to office, I totally agree with Dave. We do a lot of work for folks like Analog Devices, Verizon, UKG. They're all coming back, you know, but they're coming back very thoughtfully and really thinking about their design. And they're really thinking about where they want to play. UKG, as a matter of fact, is in Bangalore, India today. I got a text with them today. So we have to be humble to realize that we live in a very big global world. And you can find talent with a 4% or 3% unemployment rate, and it might be in Bangalore, and it might be in Noida, India. We we're doing a large deal for a company called PPD, which is owned by Thermo Electron, and in Covington, Kentucky, and we're getting $12 million from Kentucky. So I think this relates to ownership, this relates to our government, this relates to our mayor, this relates to how we interface with those that want to conduct business. I think that the office will come back. There'll be a recalibration of where the rents are, where the TIs are. I do think there's an over-rotation, my opinion, in rehabbed life science. I think it over-rotated. And I think that's going to be a really tricky time. And the really high-quality projects in life science and the really high-quality sponsors in life science are going to win. And there's going to be some losers, because that's what happens in these times. And that can be a good thing, you know. So I think that 23 is going to be a very challenging year. I think that watch medical. We're doing a large deal in Waltham with a medical doctors group. I think that is an underserved group. People are getting older. People need to, have surgeries done, and you're going to see the medical need start to come out more and more and more. I do think that the office, as it relates to Class B, there's going to be some give backs. There's going to be some situations where the numbers just don't work on some of this Class B stuff. But I think everybody sort of knows that, and I think the point of sale as it relates to brokers is going to be unbelievably important. The showing, the way that you follow up, it's going to find out and strip away, who plays well and who doesn't play as well.
Andrew, let's finish up with your thoughts.
Yeah, so I guess looking forward to 23, you gotta capture what's going on right now, because what the transactions taking place in 23 are kind of penciled out already. Right now, at one post office square, this quarter, we will sign almost 500,000 square feet of leases.
Congratulations.
So flight to quality, we've got a 25,000 square foot gym. We're gonna have a 10,000 square foot food provider on the first floor. We've got a conference center that's 8,000 square feet going into the building. Tenants are really viewing that flight to quality as a reason to bring people back. Everybody talked about bringing people back. I walked the Verizon space the other day, 300,000 feet, I saw 4 people. Right? That can't be healthy for that company. Not that they all need to be there, but more than 3 people need to be there. So companies like that need those amenities, and that's really why I think the flight to quality is taking place. I also think if you're in the B product that Dave talks about, it'll lease, you better be in your best possible light. Great tour, great showing, great materials. Make sure the white box is perfect, or the lights are on, or the bulbs aren't out and stuff like that, because you're going to get cut off the list so fast if you have second-rate product. And you can still have great B product and it'll lease, but you can't be average or below average B product, or A for that matter. So we spend a lot of time in our portfolio prepping spaces in advance. Our suburban, and this is Peter Dominski's here in the room, he has our suburban portfolio, which is a little more than 3.5 million square feet, and it's all-time high for occupancy right now. We're well over 90% because we take such an aggressive approach to prepping space and making it the best of its product class. So I would take that away from this room if I were sitting on your side. Is how do I get my product that I'm trying to move in the best possible light it can be?
You guys also take a very aggressive stance, Peter, in making deals. I mean, you're very humble to the market. You're very aggressive to the market, leading it in terms of doing some things which you turn heads. I've always thought that was a compliment.
We've never read that book, Never Split the Difference.
Yes.
Yeah. I would say, I think everybody here is a broker. Marci's an owner. I would say this to any owner right now: get out and walk around and go see space. And, you know, I was on a tour on Friday, and we saw 13 buildings, right? And
How big was the tenant?
Pardon me?
How big was the tenant?
The tenant was 9,000 square feet, but there were 13 buildings, and there's another probably 10 that this tenant you can go look at, right? But from a landlord's perspective, you've got to go out and look at your competition, and you got to respond and see. I think a lot of landlords make a big mistake by assuming that what worked in the past works. What they have to do is go out and see it through the eyes of a tenant today. There's a big landlord, big owner in town, big building, that for the last 6 years has been told, go out and see your competition and do what they're doing. And they punted, and now they're sitting there with an asset that was once a top 10 asset that now I think might break into the top 20, might. And so in a market like this, if you're not responding to the tenants and you're not listening to the brokers who are out in the street seeing this stuff every day, you're doomed. So tenants have a vision, and if they see something that they like, it doesn't matter where
And I think one thing to remember too is with tours like on that tour, what you're really trying to do is get rid of buildings.
Yes.
You're not trying to select buildings. You're trying to get rid of buildings. So anything that we can do from the tenant's perspective, the owner, the broker was a little late, gone. I didn't like the way the fee wasn't right, gone. Like, we're just trying to get rid of buildings so you can get 3 or 4, not 13. And I think that's always important to understand that why and how are you better than the competition? Why and how must you get an RFP? Because when you're looking at 17 buildings, it becomes very, very
I think it was Jim Elcock told me at Meredith and Grew when I was early in the business, you never get a second chance to make a first impression. And I think that's probably really critically important right now. I've never seen so many invitations for open houses in the last 7 years. And everybody's trying to outdo everybody else. You guys mentioned something on that flight to quality. It seems like there's a new category in the marketplace of a more trophy A++ type category, but that comes with a cost, right? I mean, is rent not important to these tenants? And from the ownership side, is it, you can go to, I don't want to pick on assets, 75 101 Fed, and a block away you've got, the new Winthrop Center, which is arguably a lot more expensive because it's new construction, but yet 75 101 is not doing deals, and Winthrop Center is. Is price not a concern anymore when you're representing your tenants, whereas the landlords, you've got to break even?
Well, I think
Yeah. So if you look at it, it's all about the employees. The cost of real estate is 5-6% of a company's OPEX. The employees are 60-70%, and you want to get those people back. So at the end of the day, a little bit more in rent is somewhat irrelevant if it's the difference of getting employees back to the office. They're not price insensitive, but it's super important. You need to be the best. You need to make the commute worth it.
Yeah, we were fortunate to be involved in, and I don't know if everybody's seen this building, One Vanderbilt, which is down at Madison Square Garden, and Heinz is involved in the ceiling heights are 16 feet. We did a deal on 60th floor for a company called UiPath, and the rent was $250 a foot. We signed that like in October. The building's fully leased, and the rents are anywhere from, I call it $180 to $280 a foot in New York City, leased. And to Marci's point, if you're gonna be in New York City, or you're gonna be in Boston, and you're gonna play, then let's go to One Congress, or let's go to One Post Office Square. So I don't think for those companies, and there are not hundreds of thousands of those companies, you've got to find out who they are, and then you got to attack them, and you make that deal. So yes, the flight to quality, if it's there in the product, those buildings will do fine, and they can actually excel, because they're hard to find the new quality. They're hard to get that type of quality with glass, ceiling height, and all the amenities that really companies want today.
And Andrew, you took a huge gamble in the management of the conversion to the skin on 1PO. Has it paid off?
Yeah, I mean, the floors that Putnam gave back before we started the project, we couldn't lease them at $45 a foot gross. So that's 25 net. The transactions we've done to date on the low rise of the building have all been north of $50 a foot net. So we've increased the net rents of that building by 25, doubled. We doubled the net rent. So that's in the low rise. The high rise of that building always performed well, but the proposals we're putting out now on a gross basis are all at or above $100 a foot. The 65,000 feet at the top of the building available. So, but it's the companies that are showing up and leasing the spaces though. Rent is important, don't get me wrong. Concessions are really important that we were talking about earlier, because construction prices are so high. But they need to tell the story of being a green company and having a conscience with the buildings and that they operate in, and they want to hear about what's going on with the the recycling and the carbon neutralization of the building, and all the things that I think that the government is going to really lay into here with the BIDO or BIDO or
I would say this because Andrew was on the other side of a deal that I lost. Okay, I was representing the owner of 400 Atlantic, which is Goulston Stores. And Goulston has two operations. They've got the whole 400 Atlantic, and then they've got a group of people at Rose Wharf. And so when that deal, it was two buildings. It was 400 Atlantic against One Post Office Square. At the end of the day, their decision to go to One Post Office Square made so much sense to me. Here's the reason why that I think they went. Number one, they were downsizing from 150,000 square feet to 100. Right, so right there, that's 30% savings just by space alone. Secondly, they looked at it and said, okay, if we stay in place, the rent was dramatically different. But if we stay in place, we have to live around a build-up. Third, the type of concessions that were negotiated, basically, and I heard this from the Goulston Stores partner, one of them who was involved in the deal. He said, look, at the end of the day, when we looked at the type of capital we were getting, the lack of construction disruption to our business, and then B, we want to get people back to the office. We looked at that and we said, there's no risk. Why wouldn't we do this, right? And at that point in time, it was just like, yeah, it makes so much sense. So there's a lot that goes into it. Everybody's competitive. I would say I've been doing this for 33 years. For 29 to 30 years of my life, all I thought of was, it's about economics. It's not just about economics. It's about lifestyle. It's about amenities. And in this environment, it's really about providing something that's going to get employees back to the offices. And the same old just won't work with the best firms willing to pay the best rents.
Well, you brought up concessions, so I'm gonna go there. So we're already experiencing a velocity slowdown in all aspects of commercial real estate. Life sciences last year at this time was double what the velocity is right now. We're already seeing concessions to this flight to quality, which usually leads to some sort of choppy water on the horizon, typically. does the panel think that there is going to be some sort of a correction in 23? And if there is, what is your prediction on the percentage of that correction? Is it a 5, 10, 15%?
Can I ask you to clarify that? Are you saying the correction in terms of concessions, or are you talking?
Well, I think the concessions are going to lead to, in order to be competitive, there's got to be some sort of corrections in the rents, right? Go back to the Class A plus bill assets class, or Marci just, brand new building, life sciences building in Watertown that's delivered, it's ready to be delivered to tenants. I imagine the velocity has slowed down a little bit in terms of your activity in the last 6 to 9 months. Are the buildings going to have, are the owners going to have to get more competitive with lesser rents as subleases continue to rise and the velocity seems to be lagging?
So I'll start. I do think it's going to be segmented by A, B, and C, and whether you're in the suburbs or downtown. So I think it's really hard to say across the board, because I do think rents in like the A product downtown, I don't see those coming down. I do see tenants don't want to come out of pocket now, even more so than before. And particularly with life science tenants, they don't want to come out even $10 a foot. So that being able to do a turnkey delivery, which to me is a 4-letter word, I hate it, but that's sort of the market that you have to play in. And we look at it as, so you're given a couple more dollars in TI or a couple more months of free rent. If your space is vacant for 6 or 9 more months, it's cost you more. So I do think there's going to be an adjustment, and you have to, and it's also deal by deal and building by building. So you can't just sort of say broad brush. I do think, I'll be the negative person. I do think Class B, I do think regardless how good you look, I do think that the rents have gone down 15, 20%. And I don't see those changing. The economics to a certain point on those buildings doesn't make sense to lower rents even more and do more TI. The math has to work on those buildings. So and we're not seeing, in the paper we're trading in the life science sector, we're not seeing rents go down. We're seeing TI creep up because construction costs have gone up. And again, all these VC-backed companies, their money is telling them, you thought you had 15 months of cash, make it last 24, 36 months or whatever it is. So they're not going to be willing to write that check.
I think at the end of the day, this is an incredibly unique time where the cost of capital has doubled in the last 12 months, right? And I think if any of you guys have any, I highly recommend that you go on YouTube and look up Atlas Ventures, their year-end 2022 market presentation. In that, one of the managing partners is talking about, it's primarily about life science, but Atlas Ventures is a venture capital firm, and when I watched this, all I could think of was tech. And when you think about Boston, the quiet power of Boston, I'm talking CBD Boston, over the last 10, 12 years has been tech sopping up blocks of low-rise space in the Class B buildings, right? So Across the Capitol is doing this, okay? One thing in that Atlas Ventures presentation that struck me was they said that in the last 3 years, there's been $60 billion of venture money poured into 400 companies, life science companies. 100 of those companies have less than 1 year of working capital. The next 200 have less than 3 years of working capital, okay? So what that says is someone like Marci, who's sitting there when a broker comes to her and says, we need to turnkey this, we need to give them $250 to $300 a foot to build this, or more, okay? What Marci has to do is...
Not there yet.
Well, I know, but what's, I think the brokers are thinking it's going there, right? And what Marci has to think of is, I don't, as Marci knows, we've worked together for 11 years, I'm not a math guy, and I'm not a finance guy, but what I do know is that when you look at that, what that guy said, okay, where he said that two-thirds, three-quarters of the tenants that are out there in the marketplace, or these companies out there in the marketplace, have less than 3 years worth of working capital, it all comes down to, all right, if we're gonna put this money in, what's the guarantee of them being able to stay alive? So that is, with construction costs where they are, and with these companies who are less than bankable, that's a real dilemma, okay? So I think we need to pay attention to that.
I think my statement earlier about we might not have scripts, but we have agendas. Atlas has an agenda. How many of those companies went IPO'd and are now massive companies that came out of that pool?
Very small proportion of them.
But the ones that do turn into massive companies. So
right, but that's not that. There's a difference between VC and real estate. Here's my belief on the VC world. VC is pumping out all this capital. They have work. No, but they did. But they're pumping all this capital out, and what they're looking for, if they're putting out, they're investing in 20 companies. If 4 of them hit it, it's a grand slam, right? That means that 16 of them are either or okay? Well, if 16, or let's say 10 of them are, there are 10 landlords that lose in that game.
no, there aren't. That's totally wrong.
Okay, well,
10 landlords, they get the space back. Atlas has got 20 more companies right behind them, or someone else does.
Okay,
and they fill up these spaces. And to Marci's point, they don't want to spend a dime.
I agree,
So
but
they show up, and now all of a sudden you do a $70 as is, triple net as is deal.
right. I think
And
that's
the landlords are high-fiving.
okay. So the owners,
your guys in your office.
from the supply side, from the owner's side, that is the rationale that led to the gold rush of everybody diving in and going and rehabbing and building a lab. I'm not a lab guy. I'm a supply and demand guy. Okay, and when you say that, yeah, up until 8, 10, 12 months ago, these tenants who were being funded by the Atlases of the world didn't have a lot of choice. Now, there's 1.5 million square feet of sublease lab space, and there's another 8 million square feet of which, 6 million is going to be available. Tenants have choice, and when they have choice, they have leverage. And when they have leverage, that's where rents kind of
So I do think it's also about, you see it in the office, you see it in the life science, it's spec suites and how you build it out. And at 20 McGuire, we did a spec suite program. Every spec suite was leased before we even were swinging hammers. And even in this market, one of the tenants put a space in the sublease market in late August. By October 1, there was a signed letter of intent. It was a spec suite for $7 a foot more, as is for the full term, because it was generic, good quality lab space spec suite. It's the same thing in office, and that's how you're going to control. Move-in ready. Tenants don't have to write a check, but that's the big thing as a landlord. What we can control, and you're spending more than you thought in those spec suites. And if you do a 3-year lease, that's fine, because if they're not going to stay, you spruce it up and you can release it to the next guy.
That's not a unique story either.
Yeah.
What we did at Core & Crosby, we started to build, which means we ordered the HVAC equipment and had really good plans. We leased 180,000 square feet before we could deliver a square foot.
When was that done?
The last deal was done 2 weeks ago at $70 a foot.
Look, from an office perspective, we absolutely need life science to thrive, because life science and tech feed law firms, advertising firms, accounting firms. So we are rooting for that. But I look out in the horizon and I see clouds in that part of the game.
Mr. Boyle's awfully quiet down there.
Yep.
Do you disagree?
Like to be. The question was, I think, concessions in 23, and we started talking about
Now you know why we didn't get to the
PE firms and no. I mean, listen. The answer is yes. There's going to be, in my opinion, the one word I would use, a recalibration in the market. There's going to be a recalibration on rents. There's going to be a recalibration on TIs. There's going to be a recalibration on expansion rights and interruption of services and assignment of subletting and signage rights and all things related to what we do, because there is not one, to Marci's point, one market. Each transaction is in and of itself the market. And some of those may not, the rent may go down 3 cents. The rent may go down $3. The rent may go down $13, because everyone's got different levers to pull. But the fact of the matter is there's not enough supply. I personally believe the demand numbers are off, because people are counting a tenant that went out in February. And, if you talk to some people, whether it's office or life science, and you say, geez, if there's 3 million feet of demand, well, I should be able to talk to 1 million square feet of people, or 2 million square feet of people, and get the proposals. So we have to be very humble to the reality of what's going on, and there are awesome companies out there. There's great companies out there. Andrew's got UKG, 500,000 feet, the most successful investment that Hellman and Friedman ever made. There's great companies out there, but I think everyone's got to understand that every single deal is different. You better be totally aware of what's going on because it's going to change, and every owner has different basis, and some owners have no debt, some owners have high debt. And those owners with no debt, if they want to fill their assets and they can play, are going to be very decisive. And the two great owners up here, they can be very decisive and they can change the market. The market's $50, they just went out of 39. Holy moly, what happened? Yeah, went to 39. And that's what you're going to see with people that can be nimble and people that can be fast. But I'm saying, different types of maybe $4.95 for you, Andrew. But that's, I think, important to understand. But yeah, I think there's going to be a correction in rents and TIs. Absolutely.
You agree, Andrew?
Rents aren't going down in one post office square, I can tell you that, right? They're not going down.
I think
They can go up.
Yeah, I think there's some. I think a certain product. Yes, I think you're right. But you can't just. There's not too many pieces of product that have that type of cachet.
With taxes and operating going up, the cost of owning
Yes,
and
exactly.
running a building really matter, right? And then you add on. Look, I heard about a lab deal in Somerville that was $350 to $400 a foot that was offered. I mean, that's not. I don't know in what market can that ever be justifiable,
Yeah.
right? And it's all a balancing act. There's no landlord, no lender that's going to allow a deal to be made where there is zero or less than zero return. Doesn't matter. It doesn't matter, right? So you're right. The cost of the basis and then the cost of capital all comes into this. But and look, there'll be adjustments.
Yep.
But I was that client I was out with on Fridays. Looking at 13 deals, he kept saying to me, "Why don't I just wait? Why don't I just wait?" And I said, if you wait, maybe at 10%, 15%. This is a guy that's primarily kind of non-tower, maybe 10 to 15%. But you have to make a decision. To sit there, is it really worth it to wait?
Right.
Well, that brings up a question. So, how do you respond to when to wait? Like, how long do you wait? Is it first quarter, second quarter, third quarter? Or do you make the decision now? Given that you think it's going to have some sort of a correction, the deals are going to be better and not at 1 PO, but the deals are going to be better in January than they are in November. Nostradamus.
No, listen. I don't think you have to be a rocket scientist to understand that in a perfect world, some smart people out there that think you should just wait a little bit. Just wait a little bit. Now. That's what a lot of people are thinking. That's what some people in the Hancock Tower and other places around here are doing. But eventually, to David's point, I believe that we're not going to need, in my opinion, a lot more information than we're going to have like in June. Is February going to be a lot different than January? Is January going to be a lot different than November? What is November different than October? This is the world that we are in. We're in the world we're in. And maybe it changes a little bit in, October. But I think this is where we're at. And I think you're going to find people, at least our clients, they want to be in great buildings. They want their people back. And they want to sell product. And they want to have good business. And you can't do that, in their opinion, if everyone is never, ever together.
The best tenants that we're working with, if you just look at the private equity firms, the financial services firms, the law firms, they're making decisions and they're not timing the market. But I will say that question that gets asked by tenants, and we ask it internally all the time, right? Are we giving our tenant clients the best advice by telling them to go make a deal today? That's a really hard question to answer. But at the end of the day, these tenants have to make decisions about how they're gonna get their people back to work. And I think, like John said, I think this is gonna be a slow evolution, and it's a day-to-day basis, it's a deal-to-deal basis.
Deal to deal. Totally deal to deal.
Just to add on, you talked earlier about what you're talking about is essentially indecision. That is the worst thing for our
Yes.
business.
Killer.
No
If this whole room was
Killer.
one office, we would have like Jordan Belfort in here telling us like, run through the wall,
Yeah,
sell them,
exactly.
push the product,
Killer.
sell it. But ready?
Yeah.
The indecision in the market is by far.
Right.
If you're going to say there's going to be headwinds in 23, you
Yeah.
just saw it.
Yeah.
You can't run real estate as a whole with indecision.
Well, I think if
If
you
it's
have,
going to go down, let's say,
certainly if you
let's
have
say it's
30
going down.
yeah,
Like,
but
let's
certainly
just
if you
cut
have
the
30,
chance.
40, 50 million feet portfolio, and you're looking at a portfolio and you're trying to figure out a portfolio. But the fact of the matter is, in a perfect world, which is not the world we live in, you'd sort of say, wait a little bit. But you have to have leadership. This room, okay, the key thing in working on a real estate deal is you got to be the leader. And these people are great at playing leader. Whether on landlord side or tenant side, you got to lead. That's what matters. And when you lead, you will get results. If you're ambiguous and you're not quite sure, then you're going to run into a wall. And what people want right now is they want some type of specific answers, and oftentimes the market will show you that. If it conducts itself correctly, the market will show who on the landlord side is the winner and who on the tenant side is the winner. It becomes self-apparent. I've always found that to be the case. But you have to have humility and effectiveness out there.
And you can't time the bottom perfectly. I mean, we've all been in this industry for decades. You can never, as an investor, I look at it, as long as you're plus or minus 5-7% on either side of it, you're going to make money. From a tenant perspective, that's not your business. You shouldn't be timing the market perfectly on the bottom. You got to make the decision first.
Because you'll always miss it.
You always miss it. Yeah.
I think you're right, Andrew, though, indecision and just lack of conviction. But the lack of conviction is completely understandable when you just look at the crossfire hurricane of garbage that's been thrown at American business. Stay at home for 2 years, rising interest rates, all the political mess, right? So tenants, it's understandable why tenants are going one step in, one step back, right? And it's very frustrating for brokers and for owners. That's the world we live in. I believe that lack of conviction is dissipating every day. That's why I feel good that now, look, it's going to be tough, but that's why I feel good that the next 2 years are going to be way better than the last 2 years for office.
Well, segue into office and a little bit about investment sales. With virtually little to none office transactions in 22. Sales, investment sales. We know of some already properties going back to lenders. It's happening more in the suburbs than it is downtown. Anybody that bought real estate in the last 7 or 8 years in downtown Boston did not underwrite those assets to go down in price and rents, I assure you. Do you think that there's going to be opportunity for owners to acquire distressed real estate in 23? And what does that do to the tenants that are in those buildings?
I'll start. I mean, yeah, there'll be opportunity. You have all the, certainly on the office side and the distress side. If you go to life science and industrial and flex, it's going to be super selective. I think it's hard to say across the board. I mean, all the big money center banks, and there's one in this room, they want, if they have a $10 billion book of office or 15, whatever it is, they want it to be zero. So there's kind of an issue there, and you have a huge loan maturity coming up in 23 and 24. So there is going to be distress, and investors are saying, okay, I've got 10 office buildings. Equity is really valuable. Which buildings am I going to support? So there will be office buildings that go back, and there's going to be, there was a deal, $125 million loan that someone was out trying to get. All day long, that should be done very easily with one lender. In this market, it was done with 5. So there's a real sort of lack of liquidity.
I think that deal was one that I was working on, and it was
great sponsor, phenomenal sponsor.
It was the 11th hour, 59 minute. That thing was still like, holy smokes, this may not happen.
Yeah, And there will be distress that in part is becoming self-fulfilling because the regulators have sort of enforced this on these banks. So that's a real problem. Not to be Debbie Downer, but
Let me ask you two a question. I look at this, and in the last 2 weeks, I've had 8 lenders on 5 different properties call and say, "What do you think about this?" When literally the last 8 years, no one's ever called me on that, right? So you start talking, you realize what's going on. I don't think these banks want it back. The bigger question is, do the landlords, do the current owners, do they have the stomach, to keep doing it? Now, does it come down to that?
so the lenders don't want it back because they get dinged even more, and
Yeah.
they know they're not good at taking it back and creating value.
Right.
So they don't want it back. But I do think, depending upon the owner, they have to pick and choose which assets they're going to support.
Yeah, I would say, ready, the 222-500 Boylston's of the world, they'll take that back.
Yeah, definitely.
We'll take that one.
Back then, right?
Did that get refinanced?
Pardon?
222,500? I know it was up for refinance.
I believe so, but I would.
Yeah, I really can't talk too much about that, but look, I agree with you. That's a tough. But I was asked this question where a lender asked me the other day. I said, okay, I know the building, I know it well, but I don't know the debt stack. I don't know any of this stuff. I said, when's the loan up? And he said, March. And I said, March. And I said, what's your basis? And he said, I'll give the number was X. But the X was like, oh my God, I'm going to call 10 friends, let's buy this building, right? But then he asked the question, can you lease it in the next 18 months? And I said, maybe I don't want that, right? Maybe I don't want to get 10 friends to buy this thing, right? So these are going to be crazy. I think it's going to be Wild West like it's with some of these types of product. And again, like we talk about conviction of tenants, how about conviction of landlords or investors, right, who are going to buy these things in a market where a lot of people think that these types of buildings are obsolete. I mean, we've had this conversation about, John and I have had this conversation about some buildings that are out there in the marketplace. I don't think anything that's a functional building downtown, that's a really good functional building, will ever be obsolete. Show me a building that's truly obsolete in Boston that's been functioning for the last 100 years. They'll figure something out.
Yeah, I think that on that point, ready, to take the Trophy A product, I think to some extent, the worse off a building is, the more dangerous it would be for them to take it back. So that's where they need the operator even more.
Yes.
So there's going to be workouts, I think, a lot of times. You'll see the buildings that landlords want back, or the lenders might want back, because they'll start to do as-is deals, and they'll start to do some things with tons of free rent instead of TI. And those are all telltale signs.
Remember those days?
Yeah, that those buildings.
The 20 months of free rent days?
But these guys to my right,
Yeah.
someone was asking me, not about you two, but I feel you guys are very similar. Someone was asking me about a guy in the marketplace, and I said, he's a shark. And he said, what do you mean by that? I said, he's a shark. And I said, in a very, very positive way. He has been floating around under the water, right, under the surface, looking for a piece of chum that's bleeding, right? That's what these guys, this is where you guys make the most money. You're looking for that piece of opportunity where you can pick it off, this vulnerable piece of opportunity, because you guys have the vision and the guts to go and say, we're going to buy it, we're going to fix it, and we're going to sell it, we're going to make a ton of money. There's a lot of those guys out there who are now is their time, because the last 15 years, how much distress has been out there. So our game calibrates a little bit differently, okay? You know what? We got to start, like these underserved assets or underperforming assets, those are ones that are going to make a lot of money for you guys and for brokers.
You need to get a loan to buy them.
I know that's
Yeah, the lenders need to step
Yeah.
up, and right now, because they got such big books that they're trying to clean out, and these lenders don't want to take anything back. They get hurt too much, and they know they can never. History has told them that they don't make money taking it back. At the end of the day, they're better off selling it before they take it back.
All right, we've got a couple minutes left. I want to take advantage of the fact that everybody on this panel has been a broker at one point or another in their career. So I look over the landscape of the demographics of the room, and there are a lot of emerging leaders in our industry. All of the organizations under the Greater Boston Real Estate Board, REFA, BOMA, CBA, have done a really good job at rising our emerging leaders up and the younger people of our industry. Having been through corrections in our careers, what is your advice for any of the young people in this room on managing what's going to might be a little bit more of a challenge for them? That there are a lot of brokers under the age of 35 that have never seen a down market. It's kind of like this. What's your advice for them?
Soak it in and go to the office. Don't stay at home. Go out and see people. Then real estate's a contact sport. It's how you learn the most. You're going to learn the most in the next couple of years than you will in your entire career. And you can't do it sitting at home.
I've talked to a lot of young people in here, and I always tell the story. When you get to 50 years old, the Social Security Administration sends out annually this sheet which says what you've earned, what your W-2 said. I got in the business in early 1987. My W-2 said 0. So I worked 11 months in 87. I made 0. In 88, somehow I made $13,000. Okay, and in 89 I made 0. Okay, so but I will tell you this: that what got me through this was I actually loved the business. I thought it was really fun, and I was working with a bunch of guys who didn't like to work. And I think in markets like this, if you're young and you've got energy and you're smart and you're passionate about it, the harder you work, the more you're going to learn. Don't think about money. Think about the deal. Get in front of a deal. Be part of a deal. Be right in front of a deal, because you're, like Marci said, there's never been a better time to learn than in down markets. And I'll finish with this. There's a great interview with this guy named Jimmy Iovine, who built Beats, right? And with Dr. Dre.
Yeah.
So they asked him, this is a guy who never went to college. He's a multi-billionaire, okay? And they asked him the question, what's your secret to success? And he said, be of service. He goes, even today, all I want to do is help people, right? Whether you get paid for it or not, because if you help people and become indispensable, you're valuable. And that's what I would say. Just be around deals and be as helpful as you possibly can to those who can help you advance.
So to that point, Freddie, when I was at the beginning of my career, first of all, Trey gave me one word of advice. We were in downtown Crossing, and he looked at me. We were walking to lunch, and there was a homeless guy there, and he looks at me and he goes, "Hey, you're one commission check away from being that guy." Right? So don't overspend, because there are going to be some lean times, right? But to add value, to be the Jimmy Iovine, you got to really know your trade, know your craft, get in your buildings, whatever product type you're in, whether it's industrial, lab, or office, or downtown, or burbs. You got to know the details of these buildings. That's how you're going to add value. If you're sub 35, the senior guy's going to want to bring you to the room because he knows that you're going to know the building inside and out. Whether it's the tenants in it, when they roll, the HVAC they run, who's running it, that space is shadow, that space isn't. So as much as being in the office is important, right, being in the field
Definitely
is just as valuable, if not more valuable. So when you are in the office, you do bring value to the table. That's what I think has been lost over the last 2 years for everybody in our industry, not just the junior brokers. I mean, you're in buildings now that you haven't been in, like 2020, you probably didn't have tours for buildings. So.
Architects, I now insist saying, no, let's have a meeting at the building instead of Zoom. They look at me like, well, what? And it's amazing how much more efficient you can be when you're actually at the building, looking at the lobby you're trying to redo as opposed to on video.
What's your advice?
Well, first of all, I think for the brokers out there, it's a wonderful business. It's an awesome business that we're in. And it's hard. Marty, I remember I started in 87, and in 89 I called my dad and asked for a $1,000 loan, and he said, no, you can move home. I was 29 years old. I had friends that were getting married and having kids, and I was living at home. Guys, it's friggin' hard. Okay, our business is hard. Okay, and what everybody says up here, you got to work. You got to really, really work, and you have an opinion. You know, I have great respect for Steve James. Steve James has an opinion. John Boyle has an opinion. What is your opinion? Who designed the building? Who's in the building? Who's got the debt on the building? Who was in the building before? To Marci's point, you got to know architects. I saw Elizabeth here from Elkus Manfredi. You got to know architects. You got to meet architects. You got to go to lunch. You got to become enthralled in what you do, because you will become a valuable asset. And somebody will say, "Hey, Dave, what do you think of this?" And he'll give that answer. So number one, you got to work really hard. Number two, you have to have humility to the market. You have to have humility in the market. I've worked with some younger brokers, and they have all the answers. Well, let me tell you, I have none of the answers. I don't have the answer. The market will find the answer. So have humility to the market. And I think number three, you know, you've got to have humility to spend. You've got to be humble in your spending. This is not, you know, we have a lot of risk in our lives, and you got to de-risk yourself sometimes in terms of mortgages and cars and things like that. And I'm serious.
So
But it's a fun business.
I'll say this. I worked with Marci for how many years? Well, we were almost 10 or 11 years, right? And so Marci was in a different part of the business than mine, but we interacted a lot.
Nobody worked hard on her.
No, and what bothers me is, like, last night I was at my desk, and it's 5:45, and 90% of the office was gone, right? Marci, when we worked together, she had kids. She had 2 or 3 kids at the time, okay? And I can remember leaving the office at 7:30 at night sometimes, and Marci would still be there. Marci would be leaving at 7:30 at the night, and I'd be there, right? I think nothing replaces hard work.
Agree.
Right? Because hard work gives you confidence, okay? The more you do, the more confident you are. The more deals you're in front of, the more confident you are. And like John said, if you don't like the business now, if you really don't like it, get out. Just get out while you're young. Get to the next step, right? But if you love it, commit yourself to it.
Because it's great. It is a great.
You can get lucky like he and I. You can actually feed a family.
It's a great business.
Please join me in thanking this esteemed group.
That was great, and concessions are not going up and rents are not going down.
Yeah, great event. Yeah, you couldn't have picked a more colorful panel, but wonderful reflections on the market today and where it's going.
I think it was a great event. It was a good market overview as far as what the future is. There's not many people that feel like they know where the future is in real estate right now, and I think that it's helpful to kind of get everyone's perspective, both the landlord, the brokerage side. It's great.
I think we feel motivated to go tour some other spaces and see what the competition is and make our product hopefully even better.
Fantastic event as always. You have the industry leaders. Those seem like they've been leaders for 30 years. So listening to them is always a good insight on what's going on. And, I think 2023 will be interesting.
How about from the development side? You're in the development world. How does it affect you guys?
I think the lenders are going to drive a lot of it in what you can do. I think generally to be a developer, you're generally optimistic and hopeful. But it's the money that you can capture and to create the ideas you want.
I thought it went really well. I mean, it's unscripted. I think that everybody spoke from their heart, and there's a lot of knowledge up on the panel. I like the idea that there was no scripts, but everybody had an agenda. So I think it went really well. I'm really pleased with the turnout.
We love Peter Evans.